Hi, I'm Angus Pearson, and I'm going to talk you through the most rudimentary building blocks of portfolio construction. Now, when it comes to investing, the concept of not putting all of your eggs in one basket is an easy one to comprehend. Spreading your risk across different types of investments so that if one investment disappoints, you haven't lost everything in one go just makes intuitive sense. But sensible investing need not be based on pure intuition. Portfolio management is founded on a set of principles and empirical guidelines, key among which is the relationship between risk and return. Usually an investment that generates a higher rate of return carries a higher degree of risk. Investments that carry lower risk tend to generate a lower return. Efficient markets ensure that there is a fairly strong relationship between risk and return. Every investment is a balance between those two factors. In fact, as Frank says,
you can't have one without the other.
Wouldn't it be great to have one of these? Well, unfortunately nobody can predict the future. While we may try our best to do so, even the cleverest amongst us are frequently wrong in our predictions. With portfolio investing, what we need is a basic framework, a rational basis from which to start putting together the components of an investment portfolio. Investors generally want to position themselves somewhere between two extremes. On the one hand, they don't want to place all of their capital on one risky bet. While the returns from doing so may be potentially attractive, the risk of losing all, or at least a large chunk of your invested capital if things turn out bad, makes this strategy unappealing. Nor do investors want to spread all of their capital across all possible bets. While overall risk is reduced by doing this, returns are very uninspiring, especially after transaction costs and taxes are taken into consideration. So if you're looking to establish a risk-return trade-off that is between these two extremes, while at the same time acknowledging that you can't predict the future, then you have to come up with a basic framework for portfolio construction that is based on the next best thing, the past. The past, of course, provides no guarantee for future performance, but over time, broadly speaking, investments belong to a high, medium, or low risk-return profile for very fundamental reasons, and it usually pays off to expect this pattern to hold, unless, of course, you have strong reasons to predict otherwise. Let's now take a look at portfolio diversification in action. And to keep it simple, let's look at a portfolio that contains just two investments. Investment A generates a reasonably high average return, but the volatility of its returns from one period to another makes it risky. Here we measure risk in terms of standard deviation of returns, a mathematical measure of the extent to which an investment's returns deviate from its average return. The bigger the deviation of the returns, the higher the standard deviation, and hence the riskier it is. Investment B, meanwhile, is less volatile, but has a lower average return. Essentially lower return, lower risk. Unsurprisingly, a portfolio made up of equal shares of investments A and B generates an average return somewhere in between the two. So what about the portfolio's level of risk? Is it somewhere in between the two investments? Well, no, it could be, but not in this case. In this case, the standard deviation of the portfolio is lower than each of the investments of which it is comprised. And this is precisely the beauty of portfolio diversification. The real benefits of portfolio diversification really come through where the portfolio components have a low level of correlation with one another, and this is key. So, returning to our two investment portfolio then. Let's assume first that investments A and B, while of different risk-return profiles, are nonetheless positively and closely correlated. Constructing a portfolio based on these two investments will help you relocate to a risk-return profile anywhere between the two investments. However, where investments A and B happen to have low or negative correlations with one another, something interesting happens when you create a portfolio with them. The effect of portfolio diversification reduces risk such that some of the portfolios comprising these two investments actually have even lower levels of risk than either investment A or B. An efficient frontier is thus created, which defines the extent to which portfolio diversification can lower overall risk without giving up anything in terms of expected return. This leads us to portfolio efficiency and how you actually measure the contribution that a portfolio makes towards reducing overall risk. Portfolio efficiency is measured by risk-adjusted return. There are various ways of measuring this, but the most intuitive is the Sharpe ratio. This is simply a ratio of return per unit of risk. The return that you want to focus on is the relevant return generated by the portfolio given all its risks. You don't want to include the risk-free return that you could receive by holding cash, so you strip that part out. And then you divide it by the overall risk of the portfolio, or in other words, the standard deviation of the portfolio. Going back to our simple portfolio where investments A and B were perfectly correlated, we find that Sharpe ratios for the various mixes of these two investments all equate to somewhere between that of each of investment A and B. Meanwhile, if we were to assume that investments A and B are instead somewhat negatively correlated, then we find that we can push to new levels of risk-adjusted return. It is here that we can find a Sharpe ratio of 1.05, which is considerably higher than that of either investment A or B. Unsurprisingly, we find that the portfolio that comes up with the goods sits on the outer reaches of this portfolio's efficient frontier. Okay, that looks like a pretty good place to stop for now. In the next part of this series, we're going to extend our scope beyond a simple two-investment portfolio and look at the interplay of multiple asset classes. Is it possible to have an overly diversified portfolio? This is going to be one of the questions we shall answer next time. So until then, goodbye.